Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me this afternoon are Jay Gragnani, head of client research and engagement at Nasdaq Dorsey Wright. We have John Lewis, senior portfolio manager at Nasdaq Dorsey Wright, and Devang Patel, wealth manager with Virtus Wealth Solutions, to discuss taking a tactical approach to asset allocation. Gentlemen, it's great to have you with us. Welcome to Trade Talks. And Jay, I'm going to kick it off with you. What are the benefits over time of having a tactical approach to asset allocation?
Jill, great to be here and great to be joined by both John and Devang as well. And one of the things that we have talked about for many, many years at Nasdaq Dorsey Wright is about the ability to be able to be tactical through various market conditions and through various market cycles. And, very much we see the need for a tactical approach to the asset allocation world, because trends can certainly persist for many, many years of asset classes either being in favor in areas that we want to own, or assets being out of favor, or like assets that we don't want to own. Very much so is the case is produce in a supermarket. We know why this time of year, while during the winter, strawberries aren't as bountiful and they don't taste as good as they do in the summertime. And those trends can persist, like I said, for many, many years. And we can even go back to recent examples of the lost decade for U.S. equities, which was really the decade of 2000 through 2000, the end of 2009, where the S&P 500 made no headway at the end of the day. Over those 10 years, the S&P was actually in negative territory. And it was during that time that the market for the S&P 500 or U.S. equities was dubbed the lost decade for equity investors. However, there was a lot of opportunity outside of U.S. markets, and particularly in emerging markets and other areas as well, that did very, very well. The past 10 years have been basically the exact opposite, where U.S. equities have dominated, in particular large cap growth U.S. equities. And so these trends certainly can persist for many ways, and the ability to be able to identify those trends and then take advantage of those trends ultimately through disciplined investment solutions can benefit investors over time.
John, let's talk about the benefits of risk-managed equity and potential tax consequences.
Yeah, thanks, Jill. So risk-managed equities do play a part in an overall asset allocation. And we can all get out our spreadsheets and calculators and talk about whether buy and hold is the way to go or doing risk-managed equities is the way to go. But the reality is that not all investors can take the full drawdown from equities over time. And if you can't do that, the buy and hold number really does become irrelevant. So a lot of investors are looking for a strategy that will essentially put the brakes on in real bad markets. And the common thread through all those strategies is you need to de-risk the portfolio somehow. And for most investors on a retail level, the way to do that is really by raising cash in the portfolio and selling those securities that are breaking down. Now, however you choose to do that, there's a common thread there, and that all generates transactions and potential realized gains every time you need to de-risk the portfolio. So when we talk about risk-managed equities, the tax consequences are a big deal. And one way to mitigate that is through the very, very tax-efficient structure of an ETF.
And finally, Devang, how do you incorporate these strategies into the investment portfolios that you manage?
Thanks, Jill. Our clients are looking for three things: diversification, tax efficiency, and risk management. Now, we get diversification because we are using a mostly broad asset indexes. So the clients, everybody wants to be diversified. And an analogy we use is, if you are in San Francisco and you have option of taking two elevators, would you take elevator which has one cable or an elevator which has four cables? Four cables is the diversified one cable is a concentrated bet. Second thing, we look at tax efficiency. Even though most of our clients love to contribute to the country, most of them don't like to pay undue taxes. And with the new regime that's coming on, most likely for a lot of our clients who are high net worth individuals, the tax bill is going to only go up. So we're looking for tax efficiency. So how do we make changes as trends change, like Jay was saying, and how do we manage risk, which is take the equity exposure down, or raise equity exposure, or make changes to different sectors as and when the strength goes up and down without generating any taxable bill for our clients. And that's where the structure of ETF ended up being the winner for us. So that's how we are using the tactical structure, which will make changes as things change. Just like Google Maps, and when you're driving, if it shows a traffic jam, you take an alternative route. So that's how we look at tactical strategies, which will make changes based on the data. So the structure we found to be most useful, Jill, was the action traded fund or ETF structure.
And why Nasdaq Dorsey Wright?
We've been working with Dorsey for a long time, and once Dorsey partnered up with Nasdaq, they have access to like a plethora of data, and they have run. Even though like John tells me all the time, he has never seen a spreadsheet he doesn't like. They have the ability to run a lot of data and back crunching, which is very essential for us to see how things would work in the future. Like history doesn't repeat, but it does rhyme.
Gentlemen, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me on Jill Malandrino, Global Markets Reporter at Nasdaq.